I published a blog post earlier today, September 8, 2025, discussing my stock, corporate bond, and Treasury bill transactions over the past few days. The 6-month Treasury bill was auctioned today at a 3.854% investment rate that prices in a 50 basis point cut in the federal funds range to 3.75 to 4% on or before the October 29, 2025 Fed meeting. The current range is 4.25 to 4.5%. The first cut, which is now at 100% probability, will be at least 25 basis points at the Fed's next meeting, which is next week. Highly anticipated cuts in the federal funds rate will be reflected in short-term Treasury bill auctions before the rate cut even occurs, which is what has happened now, when there is a certainty or very close to it, certainty that the cuts will soon happen. Money market funds will quickly adjust down in yield to reflect the federal funds cuts, depending on and the timing of when they will fully reflect the rate cut in their yields depends on the weighted average maturity of the money market fund. It may take 30 to 45 days to fully reflect the cut in the yields of the money market funds. I'm continuing to reduce my allocation to corporate bonds maturing in 2032 or later. In my last 6 weekly blog posts, including the one that I published earlier today, I've discussed selling 85 $1,000 par value corporate bonds maturing in 2032 through 2055, mostly in the 2033 to 2035 time period, which has reduced my interest rate risk some in my bond portfolio, at least to the point where I am more comfortable with that kind of risk at my age and financial condition. All 85 corporate bonds sold over the past 6 weeks were bought this year at discounts to par value, and the short-term realized gain for the ones discussed in those past 6 blog posts was $2,050.97. Snapshots are in my blog post. My concern is about the increasing possibility of a persistent rise in inflation, which will cause those longer-term bonds to decline in price unless the Fed responds to higher interest rates by creating trillions of dollars to buy longer-term treasuries and mortgage-backed securities, as they have done in the past, to suppress longer-term interest rates. Between January 2020 and April 2022, the money supply, known as M2, increased from 15.416 trillion to 21.75 trillion, or a 41.09% increase in the money supply over slightly more than 2 years, as the Fed implemented a massive quantitative easing monetary policy where it created money to buy treasuries and mortgage-backed securities, taking at one point in time its balance sheet to over $9 trillion. Those securities bought with created money paid interest, which to the Fed, which was then delivered to the Treasury Department. What is the value of the U.S. dollar when a central bank can create that kind of money over a relatively brief period of time? It's an obvious question I ask myself frequently. The rise in gold and Bitcoin at least reflects arguably some skepticism among many investors about the dollar being a long-term store of value. I still own 149 corporate bonds, TIPS, and municipal bonds maturing in 2032 to 2035, so I still have some interest rate risk with those bonds. All are $1,000 par value, and maybe 50 or so bonds maturing after 2035, where I'm very light spread out in the longer maturities. The municipal bonds that are owned are not that liquid, and I will hold them to maturity or an early call by the issuer. The weighted average credit rating is AA. They're high quality municipal bonds. I received $10,000 in proceeds from early municipal bond calls on September 1st, 2025, as noted in my August 26, 2025 blog post. The corporate bonds are far easier to sell, so that is what I've been selling to reduce my interest rate risk. Republicans are not going to admit that tariffs are taxes paid by U.S. consumers and will even deny that that has happened and will continue to happen. I noted in my blog post that Hormel Foods stated last week that it had no choice but to raise prices for its products, noting a 400% rise in input costs to it just in its last fiscal quarter alone, and a persistent rise in beef prices as Trump imposed a 76.4% tariff on beef shipments from Brazil, which used to be a major supplier to the U.S. market. The U.S. dollar has lost about 10% of its value against a basket of foreign currencies since Trump started his second term. One index that tracks the U.S. dollar's value against foreign currencies is called the Dollar Index, and it has the symbol DXY. When DXY is declining, as it has been this year, that indicates the U.S. dollar is losing value against a basket of foreign currencies, and this particular basket is weighted in the euro. A decline in the dollar's value adds to the cost of imports on top of the tariffs that U.S. importers have to pay U.S. customs before taking possession of the goods. In Trump world, none of those costs are passed on to U.S. consumers. I view gold as an alternate store of value for the compared to the U.S. dollar and other fiat currencies. One reason for the rise in gold's price over the past few years is that it has a limited supply and cannot be created by central banks. Last year, central banks bought 1,044 tons of gold. Those central banks bought more gold than they did treasuries. What does that say about their opinions about the U.S. dollar? It's something to think about, at least a framework for analysis, for future analysis. I'd like to comment that I read in a Marketwatch article today titled America's key lenders are snubbing treasuries for gold, putting your 401k at risk. Here's what to do now, end of quote. That's a subscription publication. Quote, this is from the article. When the people who print money start preferring metal that can't be printed, that's not a hedge, it's a verdict, end of quote. I view Bitcoin as an alternate currency as well that has a limited supply. I believe that the supply is limited to 21 million coins. And as of August 25th, more than 20 million, I believe, have been minted. I need to check that. If Bitcoin had an unlimited supply, then it could not function as an alternate currency, since the problem with fiat currencies is that there is no limit on supply. And we have already seen this decade how supply can rapidly increase in the money supply, US dollars and other currencies as well. I do not own Bitcoin, preferring to own gold and silver bullion as my hedges against a dollar devaluation and a potential loss of its reserve status, which I do anticipate happening. When I was 13, my father took me to a coin show in Huntsville, Alabama. Back then, it was illegal to own gold bullion, hard as that is to believe. It was true. It was illegal, not illegal, should say. It was not illegal to own numismatic gold that had been minted by the U.S. Mint. Gold was then at $35 an ounce. It was fixed at that level, and common date gold coins minted in the 1880s, 1890s by the U.S. Mint, for example, had limited numismatic value because they were so common, sold for small premiums to the price of the $35 an ounce gold. I bought my first gold coin that day. I am struggling now to hold on to what I own, since the price is so attractive for a seller who has held on to positions in the precious metals for a long time. The last time I sold, I discussed it in my blog, was sold some gold and silver in September 2011 and in January 2012, and those were the last sales that I have made of the bullion.